Market structure is important, but not as important as you've been told. I know this sounds controversial and you must be thinking, no, market structure is very important. It's important because we need to follow the trend, blah, blah, blah. So before you start writing your hate comments, hear me out and make sure to watch to the end of this video, because I'm exactly going to explain to you guys why it's not as important as it seems. Now, there's a very important time to use market structure, but it's not the end all be all. That is exactly why I'm making this video, because people seem to get confused with market structure, breakup structure, and they're focusing what its structure is doing, but they're not understanding what exactly the candles are doing. And that in your trading can sometimes be more important. So my goal for this video is for you guys to completely change the way you view the markets, and hopefully that's going to help you improve your trading and change it for the good. So with that being said, let's get straight into the video. Alright guys, so in front of me is the basic market structure. This video is not going to explain to you basic market structure. I will go over it quickly, but before we start, if you're new to the channel, welcome to the channel. Please leave a like and subscribe. You know the YouTube business, I don't have to keep saying it. It really does help push this video out, get it out to more people, which is the goal. And if more people can benefit off this content, then more people can learn to trade, and I really do appreciate it. Let me know what you think about my statement about market structure after you watch this video. Let's start a discussion in the comments below and let me know what you think. So with that being said as well, also before I forget, down below is my Discord group, so be sure to join that to discuss about this, or if you have any questions about your trades or are confused about something, be sure to join the group, because I will reply there. We also do live stream daily, so be sure to join up for that. So let's get back into this, and the first thing I want to discuss here is this is basic uptrend, basic downtrend, and a ranging market. These are your basic market structures here, these three key things. An uptrend is it has higher highs and higher lows. That's how you define an uptrend, because this high is higher than the last, this low is higher than the last low. And a downtrend is the exact opposite, where lows are lower than the last low, and where highs are lower than the last highs, and where lows are lower than the last low. Now, the key thing I want you to do to shift your trading, and this is where the controversial statement's gonna become, is that instead of viewing the market structure as trends, I want you to view it as well. On top of that, because you still have to view it, I want you to view it as ranges. So you might be thinking, what do you mean view it as ranges? That's exactly what I'm going to explain. But the first thing I need to explain here is that even though that we might have market structure looking like this, let's say on a 4-hour time frame, on a 15-minute time frame, and even on 4-hour, these could be two 4-hour candles closing bearish. If these are two 4-hour candles closing bearish for our session, because you have to understand, guys, that we trade a session. We don't trade 6 4-hour candles at once. We basically trade only maximum, and if you're doing more than this, then you're over trading 100%, but we trade maximum 1 to 2 4-hour candles per day. Personally, for me, I only trade 1 4-hour candle because I trade London session. If you trade London session and New York session, you're probably going to be trading 2 4-hour candles. But that's all you're trading. So essentially, all we have to do is concentrate on what we expect the next 2 4-hour candles to do, right? So in reality, as price action traders, we can be looking for buys when price does this and sells when price does that. But in order to do that, we need to develop a session bias and have specific rules that we can replicate over and over and over again. Because if you're buying and selling randomly against trend, against momentum, that's how you're going to lose. But let's say higher time frame, we expect price to continue up because trend is bullish, candles are closing bullish. But let's say in that for one day we consolidate and then we start to close 4-hour candles closing bearish. If that's the case where we have 4-hour candles closing bearish, that doesn't mean that we can't take sells. We can take sells, but we have in the back of our mind that structure is bullish, that we need to target our sells properly. And this is where market structure actually becomes into ranges. Because if we look at price like a range, we start to draw it a little bit different. And this is what I'm going to explain to you guys. So if we look at price like this is one range, right? This is another range, and this is another range. Now we essentially have 3 ranges. If this created resistance here, for example, we would have basically 3 ranges here. So I'm going to mark this up as range 1, and this is going to be range 2 in here, and this is going to be range number 3, range 3. So if we're viewing the markets as ranges, then we can analyze, okay, how are we going to trade in between those ranges? So obviously trend is bullish, we should automatically be looking for buys. But if price wants to continue down for 2 days, there is an opportunity to take sells. But we know that if we're looking at price as one range, two range, and another range, essentially if we're selling from here, our target's going to be here. This is where people mostly start to sell because they think that price is breaking structure. Maybe the 4-hour does this and we see a break of structure and they're like, okay, sells make sense, and then market just continues up. And they're like, oh, price broke structure, why aren't we continuing down? And that's where I say no, exactly, because you're not concentrating on where we are in the market and you're focusing too much on market structure. Just because price broke structure, if candles start closing bullish again, we're going up because the higher time frame is showing us upside. So when you're selling, you need to focus on how the 4-hour candles are closing. And I have an exact video on developing session bias, which will make that very, very clear. I have a series, I have mixed session bias and normal session bias with a free indicator. So that'll be linked up in this video here so you guys can watch and understand that fully. It will be a great addition to this video. And most of my people here are returning viewers from the channel, so they already know about this and this is why I'm teaching them. So also another reason for you to potentially consider subscribing, but at the end of the day, when we start to move down here, essentially, these become our targets. All of these lines of the range highs and lows become targets, because if we're looking for buys from the bottom of the range, we're going to target the top of the range. If we have the opportunity to sell in the range, we're selling to the bottom. Once price reaches here, our bias switches to neutral. Right, we're waiting for price to give us a clear clarity of direction, then we start to take a trade. So let me show you how this works and how this starts to affect on lower time frame, and we can look at this as an example which will probably help you guys a lot here. So let's go and look at the chart. Let's flick to the 4-hour time frame here and let's look at this. Obviously market structure is bullish here. All right, you can see higher highs, higher lows, price is continuing up like this. But prior to the session in this scenario here, we've seemed to create a resistance at the top of the range, right? We could have an opportunity to sell down here before continuing up. Instead of waiting for price to look for buys because you see market structure is bullish, you're wasting all opportunity in here. When then you drop down to the 15-minute time frames and then you see something like this, because the 4-hour was bearish, but look at the 15-minute. 15-minute has bullish market structure, and this is where you guys get confused, because 4-hour session bias is showing us downside makes sense, but the market structure on the 15 is bullish. But that doesn't mean anything, right? Because the higher time frame was showing us based on the 4-hour that price wants to go down. If that's the case, we follow that, and we use the 15-minute to find ranges. We don't use the 15-minute and 30-minute to look at market structure always. It's important, but this can always chop and change, right? If you're looking at an uptrend here, maybe this broke the structure down here, maybe this structure gets broken by this candle, and we see price like this, for example, right? This is a clear example. We hold this support, price breaks the support, but still ends up continuing bullish. We see this happen a lot, but market structure is more important respecting the higher time frame, but this is why I want you to view it as ranges. So if we mark our ranges here, obviously this is a support, the bottom of our range. We have a range somewhere around here, and we have the next range around here. So if we're looking at these ranges here, these are all tradable areas. Taking trades into here is not the best idea because of all of this rejection. So we automatically cut that out of our bias, right? And you can see we ended up forming a support somewhere around here, right? So remember, since the two 4-hour candles are closing bearish here, right? This is the next of our range. Since the two 4-hour candles are closing bearish, we're looking for sells here. We're looking for price to continue down bearish, right? So people now, they're like, okay, we've created support, a structure is bullish, this is a higher low, I should look for buys. But that's exactly wrong. Why? Because we have to follow what the higher time frame said and just view this as a range, and that's what I want you guys to change. So when we see this LTA, which I have a video on if you guys don't know what I'm talking about, just essentially means a clean area to trade. We know any candle closing below that, we can take an opportunity to sell. As you can see here, did not close below. Let's go to the next candle. This candle does close below. When this candle closes below, this is where we can take a position, put stop loss like this, and target the next low. And this can be our trade, right? We get triggered in here, pushed into profit, comes back to entry, hold a bit of drawdown here, quite deep drawdown, and eventually boom, should hit our take profit like that, right? So essentially the reason why people get confused is they're not viewing this as ranges. I'm not looking at the trend here because the trend was determined to me by the daily and 4-hour time frames. I'm just looking for ranges to trade in, and that's the major shift you have to make in your trading. Once you make that shift in your trading, I'm not saying nothing's guaranteed, but I'm sure that it will really help excel your trading and you'll start to see a massive difference. That is what I wanted to voice in this video. I hope that this video has helped. It's a quick and simple video here, running around 9 minutes, 10-minute video. Very clean, very easy to understand. I mean, you might have to watch it over twice, but hope you guys got the point and this was a useful video. Let me know down in the comments below if you understand my point by saying market structure is not as important as it seems. And yeah, with that being said, guys, take care, trade sharp, and until next time.